Are you a finance leader in the startups or scale-up world and you haven't really dealt with CLNs or convertible loan notes before? Well, today I'm going to go through what a convertible loan note is. What are the things you should be thinking about when the founder is considering convertible loan note options or is wanting to do a fundraise and is looking at a CLN as the way to do it? And then also, how do you account for that in your books? If you are a finance leader or want to be a finance leader in startups or scale-ups, then please hit the subscribe as I talk about topics that are interesting to you and will help you with your finance leadership career. Hi, my name's Alysha Randall and I am a fractional CFO, and I also train new and aspiring finance directors and CFOs. And as I said at the beginning, today we're going to look at convertible loan notes. So convertible loan notes are becoming quite popular at the moment, largely because with some startups, it's harder to do a really big fundraise. And the reason why I say some is because if you're in a really hot industry, such as AI, then raising funds and fundraising and doing a large Series A or Series B is actually not too difficult. Whereas if you're not in one of these hot areas, particularly in the UK, raising funds is quite challenging at the moment. Ever since 2021, it's been quite hard for startups and scale-ups to do a fundraise, and therefore finance leaders and founders are looking at different options. And one option is a convertible loan note. So debt is obviously another option, but today I'm just going to focus on a CLN. So what it is, it's quite popular because it's a way of using almost like a top-up round in between, say, two larger rounds. So they are essentially, they're quite flexible. It is like doing an equity fundraise. It's often with existing investors. It's unusual for you to have a CLN with all new investors. Sometimes it might be a combination, but generally you would have a conversation with existing investors to start with when looking at a CLN as a potential. You would also only do a CLN if you are planning on doing a larger fundraise in a year or two's time. Otherwise, there's no incentive for investors to invest in it. So what a CLN is it's basically it's an instrument whereby you can convert it into debt or into equity. And usually that comes at a point of an event, such as a fundraise or an M&A or an exit. So generally, the lender doesn't receive repayments in form of cash, but instead they can convert this into shares in the future, in a future funding raise, or as I said, an agreed event. So often it's flexibilities for both the startups and for the investors. So it's a way of raising funds relatively quickly. A CLN is usually put in place quite quickly, without the pressure of negotiating the valuation of the business. So whereas for investors, it gives them the potential of converting to equity at a discount rate in the future, but also it has a bit of comfort that if it decides not to convert into equity, it can convert into debt. Even though they're quicker to negotiate compared to, say, a Series A or Series B, are still quite a few things that need to be negotiated. And then this is where a finance leader needs to be mindful of what they're dealing with CLNs. So the first one is a valuation cap and a discount rate. So these determine how much equity the investors will receive when the loan converts. And they need to, as a finance leader, you need to review those and evaluate them quite carefully just to ensure that you avoid over dilution. So you would do some cap table scenarios in this instance. The second one is interest accrual. So CLMs do often come with an interest rate, which will accrue over time because it is a form of a debt instrument. You know, it's in between the two, but it's important to really factor that in when you're forecasting so that any additional costs with this are taken into consideration. The third one is legal compliance. So you want to make sure that it complies with the legal and regulatory framework. So get your lawyers involved. Don't try and do this without your legal advice. The fourth is dilution. So again, you just need to make sure how does that impact the current ownership structure. Make sure that you model that out. And so how it affects all existing shareholders. And number 5 is due diligence. In general, I don't see too much heavy due diligence during a CLN, largely because it's primarily with existing investors. However, they may want to see the latest financial statements, the latest management accounts, and the latest forecast. So just be aware that the requests for those may come through. How to account for CLNs in your finances. So you want to initially recognize the loan or the CLN as a liability. It doesn't go into your equity because it can convert into debt. So the cash is received, that goes into your cash, and then this convertible loan note is recognized as a liability on the balance sheet. The second one is interest accrual. So depending on the terms of the CLN, you may need to accrue interest on this loan. So just be aware that this should also be shown as a liability, and you may want to do this quarterly or annually, again, depending on the terms. So make a judgment there. The number 3 is the conversion to equity. So when the CLN converts, whether that be debt or equity, you need to then move that within your balance sheet. So if it converts into equity, you need to move that down, and any accrued interest potentially, again, depending on the agreement, then you would move that into the equity section of the balance sheet. And then finally is disclosure. So on your financial statements, if you have taken on a CLN, you need to disclose that within your financial statements so that any future investors are aware that there is a CLN within your business. So CLNs are, again, they're really good for doing a quick round in between the larger rounds. Existing investors, you know, it does give them some comfort because they do get potential future discounts, but they also are covered that it could potentially convert into debt as well. So it's good for accessing funds relatively quickly. It's, as I said, I'm seeing CLNs quite commonly now just because it's harder. People are pushing debt back there, say Series A or Series B, a bit further because they want to hit certain milestones before they go to market. And because it's been a bit sluggish for the last couple of years, they haven't quite hit the levels of growth that they want. But also, if you're not in those hot industries, it is a bit harder to raise. So a CLN might be a good way of raising a small amount of fund in between those larger rounds. So if your existing investors are open to it, it might be something worth looking into. Anyway, it's a quick kind of overview of what a CLN is and things to think about, particularly as a finance leader. So this should be help you for a good overview of what that is. And good luck with your fundraising. So don't forget to subscribe. Again, if you're a finance leader or in a startup or scale up, I talk about many different aspects of the role, including fundraising and your leadership role and you specifically. So have a look at what I've done so far, and I look forward to hearing from you. I'll see you next week. Cheers.